Hello, everyone. Welcome to another session of financial accounting in the Wise King Academy. Today, we will be looking at financial statements adjustments. I am Do Solomon, and it's a privilege for me to serve you through this video. What are financial statements adjustments? These are adjustments made before the financial statements are prepared. That is before the income statement and the statement of financial position they are prepared. These adjustments may affect both the income statement and the statement of financial position or either of them. These adjustments include prepayments, accruals, bad debts, bad debts recovered, and provision for doubtful debts. And lastly, we have depreciation and disposal of non-current assets. So, without waste of time, we'll say number one, prepayments. What are prepayments? Prepayments are monies received or paid in advance. Prepayments are monies received or paid in advance. Prepayments are subtracted from the income statement. This is because of the matching concept in accounting, which states that the expenses for the period must be matched against the revenues for the period. I cannot take the expenses and the revenues of the following period of the future period and I match against the expenses and the revenues of the current period. No, that is wrong. That is why prepayments at the level of the income statements are subtracted. Now, there are two types of prepayments. There are prepaid expenses, and prepaid incomes. What are prepaid expenses? These are expenses paid for but not yet incurred. These expenses are subtracted from the expenses in the income statement and are added under current assets in the statement of financial position. Why are they actually added under current assets? This is because when we pay for an expense in advance, the receiver of the money is owing us until the expense is incurred. By so doing, if he is owing us, he is a debtor, and debtors are current assets. Another reason may be this: if we had not paid the expense in advance, the money would have been in the cash still or in the bank account. That is still a current asset. So, prepaid expenses are subtracted from the expense in the income statement and are added under current assets in the statement of financial position. Now, prepaid incomes. These are incomes received in advance. When we receive income in advance, we are debtors, we are owing. Prepaid income or incomes received in advance are subtracted from the incomes in the income statement and they are added under current liability in the statement of financial position. Now, I was saying, when we receive this income in advance, we owe the people that paid us or the organization that paid us, until the goods is delivered or the service is rendered. If that is not done, we are debtors. Meanwhile, that person is a creditor, and creditors are current liabilities. So, income received in advance are subtracted from the income in the income statement, and they are added under current liabilities in the statement of financial position. The second is accruals. Accruals is another name for owings. Accruals is another name for arrears. Accruals is another name for outstandings. And accruals is another name for dues. Accruals, they are also called owings, arrears, outstanding, dues. Now, accruals or arrears, they are actually owings. They are owings. Accruals are expenses incurred but not yet paid for, or incomes due but not yet received. Accruals in the income statement are added. There are two types of accruals. There are accrued expenses, and accrued incomes. Accrued expenses are expenses incurred but not yet paid for. Accrued expenses are added back to the expense in the income statement and are also added under current liability in the statement of financial position. This is because when we incur an expense and we have not yet paid, we are owing the provider of that service until we pay. And by so doing, those people are our creditors, whereas we are a debtor to them. That is why accrued expenses are shown under current liability in the statement of financial position. Accrued incomes or income received in arrears. These are incomes due but not yet received. Accrued incomes are added back to the incomes in the income statement and also under current assets in the statement of financial position. So, let me take a short example on this. We have a tenant and we have a landlord. What binds them is known as rents. The tenant pays rent to the landlord. Now it means to the tenant, rent is an expense, and to the landlord, rent is an income. If the tenant pays rent in advance to the landlord, it means that in the tenant's book, the landlord is owing the tenant. Until the period for the rent has elapsed, the landlord is owing the tenant. That is why expenses prepaid are current assets. If we come now to the books of the landlord has received rent in advance. By so doing, he is owing the tenant until the period is incurred. So if he's owing the tenant is a debtor, whereas the tenant is a creditor. So it means that income received in advance, rent received in advance, they are current liability. Now, let's go in the case of arrears. The tenant has not yet paid the rent, maybe for the previous quarter. It means that the tenant is owing the landlord. To the tenant is an accrued expense. To the landlord is an accrued income. By so doing, since the tenant is owing the landlord, in the tenant's book, the landlord is shown as a creditor because the tenant has an obligation towards the landlord, payment of rent. Whereas in the landlord's book, the tenant will be shown as a debtor, current asset, until he pays the amount of rent due. Let's not forget, in accounting, we are working on the accrual basis. With the accrual basis, expenses and incomes are not recognized when the money is received, but expenses are recognized when incurred. Revenues are recognized when earned, not actually when paid. And this is the reason why all of these adjustments are done. Okay, let's make a small resume on prepayments and accrual. Nota bene, prepaid expenses, prepaid expenses and accrued incomes are current assets. Very, very important. Prepaid expenses and accrued incomes are current assets. Accrued expenses and prepaid incomes are current liabilities. Prepaid expenses and accrued incomes are current assets, while accrued expenses and prepaid incomes are current liabilities. Now, the last thing is prepayments in the income statement are subtracted. Meanwhile, accruals in the income statement are very, very important. Prepayments in the income statement, they are subtracted. Meanwhile, accruals are added. Now, if prepayments are given at the beginning and at the end of the period, how can we calculate the expense due to be charged to the income statement, or the income due to be added to the income statement? Now let's look at this account. This is an expense account. Now, if we have prepayment at the beginning of the period, we have a prepayment brought forward. Prepayment brought forward. Yeah, accruals or owings brought forward. Why is expenses prepaid debited? It's because it's a current asset. Expenses accrued credited is because it's a current liability. Now, we generally say all expenses are debited. Why? Because when we make payment for an expense, the cash book is credited. Meanwhile, the expense itself is debited. So I'm going to put here cash flow bank. And now at the end of the period, I'm going to have the accruals carried down. I will explain that. And I'll have here prepayments carried down. Now, look at this account here. This account has 10,000 and 6,000. This account has a debit balance of how much? 4,000. So where should the balance carry down go? On the credit side. So it means that when balancing an account, note, if the account has a debit balance, it means the balance carried down will be on the credit side. If the account has a credit balance, it means the balance carried down will be on the debit side. Very, very important. Please take note of it. If you look at your bank account and your balance carried down at the end of your balance carried down, that's your balance at the end of the period, is on the debit side, it means it's a bank overdraft. If at the beginning of the period your balance brought forward is on the credit side, it means it's a bank overdraft. But on the contrary, if your opening balance is on the debit side, it means you have money in the bank. That's an asset, cash in bank. If at the end of the period your balance carried down is on the credit side, it actually means it's a debit balance. So you have money in your account. Okay. So when you look at this, so accrual is a credit balance. So at the end of the period is brought on the credit side, on the debit side rather. Prepayment is a debit balance. At the end of the period is brought on the credit side. So if we balance this account, the total must be the same. We have Y and Y. Now, if we sum all of this, we have this, sum all of this, we have this. Now, something is lacking, which is what should be taken to the profit and loss account. So that is the amount of the expense due for the period, as you can see. Now, income. Opposite of expense is income. Everything you see here comes in the income account on an opposite direction. Okay, this is an income account. Income or revenue is the same thing. So, income, here we are going to have owings and changing terms. I could still write arrears or accruals. Brought forward. Here we have prepayments brought forward. Now, expense income accrued or income in arrears are current assets. That's why you see here is debited. Meanwhile, prepaid income or income received in advance are current liability. That's why you see income from the credit side. Now, it is generally said all incomes are credited. Why? Because when we receive an income, our cash book is debited. Meanwhile, the income itself is credited. So we have here cash stroke bank. At the end of the period, since prepayment is a credit balance, we bring it to the debit side. Prepayment carried down. Accrual or owings is a debit balance, so we take it to the credit side. Owings carried down. This account must balance. We have here Y and Y. So the difference of this account will be what will be taken to the profit and loss account. So if we have expenses and incomes at the beginning and at the end of the period, we can prepare these accounts to be able to calculate the expense or the income to be charged or recognized in the period. So these are the first two adjustments. Number three, we have bad debts. Bad debt. And bad debt, bad debt recovered, bad debt recovered, and provision for doubtful debt. Okay, like an introduction to this, all of these things we see here, bad debts recovered, provision for doubtful debt, they occur as a consequence of debtors in the business. Debtors, account receivables, or trade receivables. Here we are talking about customers to whom we sell goods on credit, to whom we provide services on credit. The business world is very competitive, and now many people want to go into business, but on favorable terms. What if you tell your customers it's cash and carry? Your next competitor will tell them, come and take, go and sell, and come and pay. So over the history of business, debtors and creditors are major elements of assets and liabilities. Very, very important. You cannot do business without borrowing. It is difficult. You must have trust. You have trustworthy customers to whom you can give services or you can give goods and permit them to pay later. And that is going to bring about debtors in your statement of financial position. Thus, debtors arise as a result of what? Credit sales. But now, when there are debtors, there are some customers or some debtors who might not pay their debt, who might not pay part of their debt at all. And by so doing, such debts, they are called bad debts. Bad debts are debts that cannot be recovered. Bad debts actually occur when a debtor or a client has been declared bankrupt, that occurs only through a court action. A bad debt can occur when a customer refuses to pay part of the amount of an invoice or the entire amount of an invoice. And after we have tried everything, the organization has tried everything to recover the amount and it has failed. Such a debt is declared bad. Bad debt is a normal trading expense and is inevitable, especially when sales are made on credit. That is when we have debtors. So, bad debts are charged as an expense in the income statement and they are also subtracted from debtors in the statement of financial position. This is what you should know. If bad debts appear in the trial balance, it means that the bad debt has already been subtracted from debtors. So the debtors is net bad debt. But if bad debts appear in the additional information, when they give you additional information, they tell you a client has been declared bankrupt of this amount. It therefore means that no adjustment has been done. By so doing, this bad debt will be charged as an expense and will also be subtracted from debtors. But in the statement of financial position, they are telling in the trial balance, they are telling you that it has already been subtracted from the debtors. So the only thing you have to do there is only to charge us as an expense. So that is bad debt. The second one is bad debt recovered. Bad debts recovered. What are bad debts recovered? These are debts that were considered in a previous period as bad, maybe 10 years ago, 5 years ago, as bad, but are recovered in the current period. If there was a debt, a customer that was owing you 3 million, and the customer was declared bankrupt, and now the customer tried and restored his business, and now the customer comes onto you. I know I was owing you 3 million, but this is 1 million. Won't you take? You will take. That is a bad debt recovered. Now, accounting logic requires that we recognize, the amount of the debt that is recovered as if we sold to the customer, they will recover it. So it means that there is a net effect. The debtor's account does not change. But the net effect of bad debt recovered is this. You add bad debt recovered to the gross profit as an income, and you also add it under cash in hand or cash at bank. And by so doing, this is an adjustment that is rare in practice, in exams, in accounting. But if it comes, this is what you should know. If bad debt to recover appear in the trial balance, it means that it has already been included in the value of cash in hand and or cash at bank. And by so doing, it should only be added to the gross profit as an income. But if bad debt appear in the additional information, it means that no adjustment has been made. And by so doing, what should you do? You should add it to the gross profit as an income, and you should also add it either to the value of cash in hand or cash at bank. That is bad debt recovered. Now we move to another important aspect, provision. Provision for doubtful debt or provision for bad debt is the same thing. Now, what's a provision in accounting? In accounting, a provision is a liability of uncertain timing or amount. It's a liability of uncertain timing. You don't know when it will occur or amount. But you make provision so that when the expense, the liability, occurs, you are ready to deal with it. So this is what I was saying. Provisions for doubtful debts, they are allowances made so that if bad debt occur, it should not destroy the business. You know, when you sell on credit, debtors arise and there's a possibility of some not paying. So to avoid that, if they don't pay, it should not crumble the business. You make a provision. you make an allowance for doubtful debts. Now, these provisions for doubtful debts are usually calculated as a percentage of debtors. They are usually calculated as a percentage of debtors. And they are charged as an expense in the income statement and subtracted from debtors in the statement of financial position. Now, if in your additional information you are told that debtors should be 3% of account receivables, you calculate the 3%, that 3% calculated, you charge it as an expense and you also subtract it from debtors. But the provision that is given in the additional information is the provision for the period. What if we have a provision for doubtful debts in the trial balance? If there is a provision for doubtful debts in the trial balance, it means that that provision is the provision of the previous period. If there was provision in the previous period, the provision for the present period is calculated and compared to see if there is an increase or decrease in provision. And that will be what will be taken to the income statement. So when there are provisions at the beginning and at the end of the period, only the increase or decrease is taken to the income statement. There is an increase in provision if the provision made for the period is greater than that of the previous period. And this provision is charged, the increase in provision is charged as an expense in the income statement. Meanwhile, the total provision for the period, that is the one on the additional information, is subtracted from debtors. On the contrary, if there was a decrease in provision, this decrease is added to the gross profit as an income. The total provision for the period, additional information, is subtracted from debtors in the statement of financial position. So that is it about provision for doubtful debt. Very, very important. And the last aspect is depreciation. That's number 4. Depreciation. Depreciation and disposal of non-current assets. So let me start with depreciation. Depreciation is actually the loss of value, the wear and tear of non-current assets due to usage and or passage of time. Now, when we buy non-current assets, we attribute to the non-current assets a useful life. And we assume because they are in use, they are losing value. And because they are losing value, we have a plan to replace those non-current assets at the end of their useful life. So what do? We provide for depreciation at the end of every period. These depreciations are made in order to replace these non-current assets at the end of their useful life. Now, take note, there is something we call accumulated depreciation. This is the total depreciation on an asset throughout its lifespan or throughout a particular period. So, first year, second year, third year, if we add all of that at the end of the third year, it gives the accumulated depreciation for the third year. Now, this is something. The depreciation for the period is usually calculated or given in the additional information. Depreciation itself is a normal trading expense. Normal trading expense that is charged in the income statement. So the depreciation for the period is calculated maybe using the straight line method or the reducing balance method. There are other methods, but the two most used methods, they are the straight line and the reducing balance method. Now the depreciation for the period is calculated using the additional information, either of these methods, and it is charged as an expense in the income statement. And the accumulated depreciation in the trial balance, if any, is the accumulated depreciation in the previous period. Please take note. According to the historical cost concept of accounting, it states that all non-current assets should be shown or displayed in the statement of financial position are their initial cost less accumulated depreciation. The difference between the initial cost and the accumulated depreciation gives the net book value. Very, 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 very important. So, the accumulated depreciation in the trial balance is that of the previous period. Now, when we calculate the depreciation of the present period, we need to add it to the accumulated depreciation of the previous period, which is in the trial balance. It is going to give us now the accumulated depreciation of the period. If we take the accumulated depreciation of the period, we subtract from the initial cost, we have the net book value of the period. Please, over the history of accounting, people have been saying provision for depreciation. No, it is not provision for depreciation. Till date, you find questions in accounting and you see provision for depreciation there. It's a wrong appellation. That word provision for depreciation is actually accumulated depreciation. So please, if you pick up a question and you see provision for depreciation, this value is usually credited in the trial balance. It is actually accumulated depreciation. Now, disposal of non-current assets. A sale of non-current asset is called disposal. Now, when an asset is disposed, the value, the cost of the asset is removed from the books. The accumulated depreciation of that asset disposed is removed from the books. And by so doing, non-current assets may be disposed at a profit or a loss. A non-current asset is disposed at a profit if the value or the amount of the consideration is greater than the net book value of the asset. Then it has been disposed at a profit. But if the amount of the consideration is less than the book value of the asset, then it has been disposed at a loss. Profit on disposal of non-current assets are added to the gross profit as an income. Meanwhile, losses on disposal of non-current assets are charged to the income statement as expenses. So this is what we need to know. Now I'm going to put down a non-current asset account. This is a non-current asset account. Now here you might have the net book value brought forward. Here you have the net book value carried down. There are two things. There's one thing that will make, or there are two things that will make the value of non-current assets to increase. Number one, purchase. Maybe we buy cash to bank or an exchange. Or maybe the asset comes in as capital, is debited. Maybe we have revalued our non-current asset and there's an increase in revaluation. So increase in revaluation. On the credit side, what makes the value of non-current assets to drop? Number one is depreciation. Or you can also have a decrease in revaluation of non-current assets. That is it. And now another thing that makes the value of non-current assets to decrease is disposal. And this disposal here, what we put is the net book value of the asset disposed. Usually, when we prepare this table or this account, is to determine the value of depreciation. When we'll be looking at cash flow statements, we'll be looking at single entries and incomplete records. So, preparing such an account will be to determine either the value of depreciation or to determine the value of non-current asset purchased during the period. So, this is all about financial statements adjustments. Now, let me say other few things. There's an aspect that is particular about sole proprietorship and partnership in accounting, and that aspect is drawings. A shareholder can never withdraw money out of the business because the shareholder and the business are two separate people. But in partnership, sole proprietorship, they can withdraw money. That's drawings. Drawings might be of goods, it might be of cash. Please, if drawings appear in the income state, in the trial balance, it means that it has already been subtracted from cash or bank. But if drawings appear in the additional information, it means that no adjustment has been made at all. By so doing, it should be subtracted from the income statement. Sorry, subtracted from the cash or bank in the statement of financial position. Please, this aspect of drawings is adjusted only at the level of the financial position. What am I saying? If it is drawings of stock, goods, you should not adjust, remove that stock, that drawings from stock in the income statement. No. What would the opening and the closing stock as given? But when you are using the closing stock in your statement of financial position, that is when you subtract the drawings. Particularly when drawings appear in the additional information. If it appears in the trial balance, it means all adjustments of that drawings has been done. But if it appears in the additional information, please take note that adjustment is only at the level of the statement of financial position. If it is drawings for cash, you subtract it from the value of cash or bank. If it is drawing of stock, you subtract it from the closing stock. So these are the adjustments. With this, you carry out the adjustment, you prepare your income statement. I tell you the truth, it must balance. Another thing you should know, if they say returns on the trial balance, returns on the debit side is returns inwards. Returns on the credit side is returns outwards. If they say discount on the debit side is discount allowed. Discount on the credit side is discount received. If they say rent normally is an expense. But once you see the amount on the credit side, it means it's an income, rent received. Please take note of this. If you see the value of your bank on the credit side, it means it is bank overdraft. So these are all the elements pertaining to the adjustments, end of year adjustments, in order to prepare the financial statement. So we are going to look at some examples. I'm going to end this video by solving some short questions here. That's question 1, and I solved one question. Now I'll make another video where I'm solving an extra 2 questions, and that's going to be separate. Now the link to these questions will be on the description section of this video. You can download. But notwithstanding, I'll crop and put on the screen so that you can see. So please download the question, attempt them, and if you have other questions you can send. Make comments, share the link, and please don't forget to subscribe to the channel. Hit the notification button so that every time when we upload a new video, you're going to be notified. Now let's go. Question number 1, basic. This one is mainly on prepayments and accruals. The financial year of lease scheme ended on the 31st of December 2011. From the following information, ascertain the amounts to be included in the statement of comprehensive income for the year ended 31st December 2011 through the use of ledger accounts or otherwise. Number 1, rent. Owing at 1st January 2011, 110,000. Paid in 2011, 540,000. That is the only one given. So we have 2 things there. This is rent. Rent is an expense. We have owing at the beginning of the period. An expense owing is a current liability. So put owing here, 1st of 1st 2011, which is how much? 110,000. And now, paid during the period, the amount we paid for rent. You know, expenses are debited, but we pay them. We credit our cash book and we debit. So I have a cash through bank. If you pay by check, that is 540,000. Now they are asking for the amount of the expense due in the period. So what should be taken to the expense, to the profit and loss account for this expense? That was also, this is 540,000. You also have to be 540,000. So if we subtract, we are going to have what? 430,000. That is the value of rent for the period. Now, this actually means that we were owing 110 at the beginning of the period. We paid 540. That actually cleared up the 110 that we were owing at the beginning of the period and the one that is due for the period, which is 430,000. The second transaction, marketing cost paid in 2011, 110,000 francs, owing at 31st December 2011, 34,000 francs. So this one is at the end of the period. Owings at the end of the period is simply added. So the marketing expense or marketing cost, we take how much we paid for the period, we paid 110,000. Sorry, 111,000. And we're still paying 34,000 at the end of the period. Don't forget, prepayments at the end of the period are subtracted. Accruals at the end of the period are added. Just know. So this one is going to be wrap up page 145. 145,000 francs CFA. Next one, royalties earned. Wow. So you can see this one is an income now. Royalties earned. Received in 2011, 200,000 francs. Still owing at 31st December 2011, 400,000. A. Cash received. Owing 2011. So there was still an income owing. And this is an accrual at the end of the period. It simply added royalties earned. So it's an income. So the money we received was 200,000, but they were still owing us 40,000. So it means the total royalty for the period to be recognized in the income statement is 240,000. Insurance prepaid as per January 2011, 32,000. Paid in 2011, 865,000. Wow. This one was actually at the beginning of the period. So this is insurance. This is insurance account. Now, prepaid at the beginning. Remember, expenses prepaid are current assets, so they are debited. Prepayments brought forward. 2011, that was page 32,000. How much did we pay? Cash stroke bank. That was 865,000. Will we owe anything again? No. So the total here is 0, 0, 7, 9, and 8. So we have here profit and loss account, which will be 897,000. That's 897,000. And lastly, we have wages and salaries. Wow, I love this one. Paid during 2011, 470,000. Owing at 1st January 2011, 25,000. Owing at 31st December 2011, 87,000. So we can see we are owing at the beginning and at the end of the period. Remember, wages and salaries. These are expenses. So owing at the beginning of the period is a current liability. So we take it on the credit side. How much was that? That is 25,000. We paid cash to bank. How much? We paid 470,000. 470,000. And at the end of the period, we're still owing. Owing carried down. That was 87,000. So the total here will be 557,000. 557,000. But what should be what we take to our profit and loss account? We need to subtract that. That will be 500 and 522,000. I'm not making a mistake. This plus this 7, 532,000. But this plus this is 7, this plus this 5 and 5. So the amount of wages and salaries due for the period is 532,000. So that's the amount of wage due. So this is actually a minor example on how to calculate the expenses and income due for the period given prepayments and accruals. Now we are going to take complete examples. Now this is what I'm going to do. I'm going to end this video at this level. And the next video, I'll be solving complete questions on adjustments, doing the adjustment, preparing the income statement and the statement of financial position. So please move to the next video. Please share this link for others who have never prepared or who have been preparing and it's not balancing. They don't understand why their statement of financial positions are not balancing. Move to them, give them this information, and attempt the other exercises and let them see the other exercises in the other video. Thank you very much for watching. Don't forget to subscribe to the channel. Share the link for others also to benefit. And God bless you.